Irish property prices have smashed through their Celtic Tiger peak. As of mid-2025, the median home price is over €370,000. That is roughly 30% higher than the pre-COVID levels. But remember, this isn't 2007 because mortgage rates have climbed sharply, and from 2026 onwards, a new wave of legislation will bring in rent caps and effectively ban no-fault evictions. So the real question here isn't just about how high prices are, it's about whether those prices are still justified by the returns that landlords can actually earn. Has the traditional landlord model been broken? I'm a financial planner and I work with clients all across Ireland to analyse both new investment opportunities and existing property portfolios to see if they're pulling their weight or if the capital would be better deployed elsewhere. In this video today, I will show you the real numbers behind rental returns in 2025, how the new rent caps and eviction rules could impact landlords, why positive cash flow doesn't always mean profit, and how to calculate the real return on your capital, not just the headline yield. Despite higher rates and tighter rules, Irish property continues to attract investors. Let's look at what still works in 2025. The first is rental demand remaining very strong. Ireland's population has reached about 5.3 million and it's continuing to grow. Net migration added over the last year added 80,000 people, and most of those arrivals go into rentals first. Smaller household sizes and urbanisation add even more pressure. According to DAF's 2025 residential market report, there are around 1,800 residential listings nationwide at any given time. So for landlords with well-located properties, tenant demand is almost guaranteed. Then there's long-term capital growth. Ireland needs about 50,000 or more new homes every single year. In 2024, only 30,000 were built. That shortfall, now estimated at 250,000 homes, isn't closing anytime soon. So, over the next 10 to 20 years, the supply gap supports long-term price appreciation. Property is also an inflation hedge. Inflation erodes cash savings, while property tends to move the other way. As costs and wages rise, rents and house prices typically follow. Even in rent pressure zones, landlords can increase rents by about 2% annually. Now, it is not perfect, but over time, it helps preserve your purchasing power. Leverage can multiply returns. €100,000 invested in shares buys €100,000 worth of assets. €100,000 of property could secure you a property worth $300,000 with a mortgage. If the property rises by 10%, the investor gains $30,000. That's a net return of 30%. But leverage works the opposite way as well. If values fall or costs rise, the equity also takes the hit. Property markets are also inefficient. Financial markets are highly efficient, property is not. That means that deals are messy, negotiated, and often mispriced. So, skilled investors can always find value through negotiation, refurbishment, or spotting opportunities that others miss. This kind of alpha is rare in liquid markets and it remains one of property's main attractions. Finally, property offers tangibility and control. Unlike shares or ETFs, property is a physical asset. You choose the location, you choose the tenants, and you decide when to renovate, refinance, or sell. For many investors, that feels safer than holding purely financial assets. On the surface, Irish property still looks attractive, but when you dig into the real numbers, especially for new investors or those with mortgages, the picture changes. Let's look at the key challenges facing landlords in 2025. The first is higher interest rates. These interest rates erode returns. In 2020, I secured a buy-to-let mortgage at 4.65%. Today, the same loan will cost 5.55. On a €300,000 loan, that's over €2,000 extra each year in interest. And that hits your cash flow directly. What once looked like a 6% yield, now you could be lucky to break even, or you could even run at a loss. Net yields can also be misleading. On paper, you may see a gross yield of 7%, but once you factor in insurance, property tax, management, and maintenance, that often shrinks to about 2 or 3% net. Now, compare that to a low-cost global ETF, which can deliver between 5 and 6% after tax. That's liquid, diversified, and passive. Remember, when a hands-on leveraged investment underperforms a passive alternative, that's not just inconvenience, it is a strategic error. Rent caps will limit your upside. From 2026, rent increases will be capped at 2% per year. Even if inflation runs at 5 or 6%, your rental income can only rise by 2%. That could be €30 or €40 more per month, while your costs could climb much higher. Insurance premium, the maintenance and repairs, waste collection, your property management fee, none of these have caps. Over time, your real income shrinks. Managing tenants is going to become more challenging. From 2026, no-fault evictions will be banned for larger landlords. Smaller landlords will be restricted to narrow grounds such as a sale, a renovation, or family use. If a tenant stops paying or the property is damaged, you could be stuck. And the RTB disputes often drag on for months, so that is a serious risk to you. Outsourcing could also wipe out all of your return. If you're relying on estate agents, managers, or contractors for everything, fees can take 20 to 30% up to your gross rent. That's before you pay tax. And in many cases, landlords who outsource everything will be lucky to break even. Another mistake I see landlords making is they confuse positive cash flow with positive returns. Imagine you earn €2,000 net rent per year, but you've tied up $100,000 in deposit, legal fees, and refurb costs. That is a 2% return before tax. Meanwhile, a pension or ETF portfolio could deliver 5 to 7% net, with much less tax, with much less hassle, potentially better tax treatment. So the question here is pretty simple. Is your capital working as hard as it could? If the answer is no, then the rental property is dragging down your wealth strategy. Too many investors stop at one question: is the property cash flow positive? But that's simply not enough. The better question is this: what am I actually earning on the capital that I've put in? This is your return on your equity. It measures how efficiently your money is working after costs, after taxes, and after all the hassle. Here's a simple example. You invest €100,000 between deposits, stamp duty, solicitor's fees, and all your light refurbishments. Your net cash flow after your mortgage payment is running around $2,500 per year. That's just 2.5% on your capital, and that is before tax. Now compare it to alternatives. Pension could return 6-7% net with tax relief. A global ETF could return 5 to 6% after tax. Reinvesting in your own business could produce even higher returns. Suddenly, the property doesn't look so attractive. And here's the key. Wealth isn't just about owning assets, it's about owning the right assets. If your capital is tied up in an underperforming property, it's costing you, not just in terms of money, but in terms of time, tax, and lost opportunity. And if you're not checking your return on equity regularly, you may not even be realizing this. From March 2026, a major legislative package will reshape the rental market. If you're a landlord or thinking about becoming one, these rules will directly impact your returns, your risk, and your flexibility. The first rule is rent increases will be capped at 2%. So even if inflation hits 5 or 6%, your rental income cannot move above 2%. Rule 2 is evictions will become far more restricted. No-fault evictions will effectively be banned for landlords with 4 or more properties. Smaller landlords will only be able to evict in limited cases for a genuine sale of the property, for a substantial renovation, typically where you're adding size, or where a personal or family member may be using the property. This means if a tenant stops paying rent or damages the property, you can be stuck for months or even years. With RTB disputes already moving slow and their leniency towards tenants, this is a big risk to you. Rule 3 is stronger RTB oversight. All landlords must remain registered and fully compliant with the Residential Tenancy Board. But the system is often slow, costly, and heavily tilted towards tenants in any type of dispute. Put it all together, and the direction here is clear. More protection for tenants, less flexibility for landlords, much higher burden on compliance on you, so you can no longer rely on rising rents or quick evictions to protect your returns. From 2026 onwards, every landlord will need to think like a business operator, not a passive investor. So let's take a real property example. On myhome.ie, there's a 1-bed apartment in Charlottes Quay in Dublin 4. The asking price is €275,000. To figure out if this is a good investment, we need to make some assumptions. For rent, let's go to Daft and search for a 1-bedroom apartment in that area, which would be in the border between Dublin 2 and Dublin 4. The average rent comes in about €1,900 a month, or €22,800 a year. Looking at the pictures, the bathroom and kitchen could need a refurb, so let's estimate €8,000 for this. On the purchase side, assume 30% deposit, which is $82,500. We'll add in $6,000 for stamp duty and the solicitor's fees. That brings the total cash invested to €96,500. The mortgage would then be 70% of the price, which is $192,500. At today's rates, 5.5% over 25 years, the repayments would be about $14,185 per year. Now that we've set assumptions, we're going to look at my property investment tool. I will make this tool available to you in case you want to assess your current or any potential future investments. So let's zoom on the performance metrics. We'll start with the gross yield. This is the annual rent divided by the purchase price. So here it's 22,800 divided by 275. That is 8.3%. Gross yield is a quick back-of-the-envelope test. It tells you how much rent you collected compared to the value of the property before costs or financing. Anything above 6 is strong, between 4 and 6 is average, but below 4 is weak. So here, this is clearly in the green zone. Then we have the net yield. This is the net rent after expenses divided by the purchase price. So here it's 19,800 divided by 275,000, which gives us 7.2%. Net yield gives you a truer picture of what's left after running costs. Anything above 5 is strong, between 3 and 5% is average, and below 3 is poor. So again, we're comfortably in the green with this metric. Now let's get to the most important number for most investors, and that is the cash on cash return. This isn't about the property's value or the gross rent. This metric answers one simple question. Based on the real cash I'm putting down today, what is my annual cash return? You calculate it by taking the annual net cash flow, that's the rent that's left over after all of your expenses and your mortgage payment. Then you divide that by the total cash that you invested up front. So that could be the deposit, your stamp duty, legal fees, and any refurbishment budget. In this deal, we have $5,615 in net cash flow, and we invested $96,500 of our own money. So when you divide those, that's the $5,615 by $96,500, you get a cash on cash return of 5.82%. So how do we interpret this? Well, here's a simple rule of thumb. A return over 8% is generally considered strong. A return between 5% and 8% is borderline, but it could be acceptable depending on your goals and expected capital growth. Anything below 5% is poor and likely not worth the risk and hassle. So on paper, 5.82% return is at the low end of borderline. It suggests that for every euro you put in, you're getting just about 6 cents back in cash flow each year. But this is the critical part that changes everything. 5.82% is pre-tax number. Your real return and what ends up in your pocket after the government takes its share is important to look at your own tax situation. If you're a higher rate taxpayer, you could be paying up to 52% on the rental income. This means after-tax return isn't actually 5.82%, it's slashed to about 2.8%. Now let's reframe that. You've tied up $96,500, taking on a significant mortgage, accepted all the regulatory risks, the hassle of being a landlord for a 2.8% annual return. Again, we need to compare this to other alternative assets. Again, the passive diversified ETF, which realistically could give you 5 to 6% after taxes and a hands-off portfolio, or the powerful tax relief and compounding you get with a pension. Suddenly, the property deal moves from strong on paper to an in-between or maybe even a no for a higher earning investor. The numbers simply don't justify all of the risk and effort. This is the most common oversight. You cannot stop at the pre-tax yield. The real investment decision happens only after you run the numbers through your own tax situation. Remember that 5.82% could just be 2.8% after tax, or it could be different if you held it through a company. But without the final step, you're not analyzing a deal, you're just doing half of your homework and not going to give yourself the complete answer. Another metric to look at is the gross rent multiplier. This is the price divided by the annual rent. So here, it's 275,000 divided by 22,800, and that gives us 12.1%. Anything under 12 is strong, between 12 and 16 is average, but over 16 is poor. So this sits right on the border between the green and the amber. Many landlords will just simply stop at the gross yield or even just look at the cash flow. But these numbers only tell you part of the story. The real picture here comes from combining all the metrics and running them through your personal tax situation. Only then can you see if the deal is viable. And this doesn't just apply to new deals, you should also be looking at it at your existing property portfolio. I regularly analyze clients' portfolios and find rentals that look fine on paper, but when you dig into the numbers, the overall returns are quite disappointing. It's also important to make sure that we compare the investment and capital through property with alternative assets. Remember, positive cash flow is simply not enough. The only number that really matters here is the return on your capital in any way we look at it. It must be after costs, after taxes, and after hassle. So given everything that we've seen, who does property investing still make sense for in 2025? Well, firstly, the era of the accidental landlord is over. Today, you likely fall into one of two categories. That is the passive capital defender. You're primarily a cash buyer or have a very small mortgage. You're not chasing high returns, you're seeking a modest inflation-protected yield and a long-term store of value. You're willing to pay professionals to handle all the hassle, making it truly passive for you because you can afford it. The second is the active business operator. You're not just a landlord, you're running a property business. You've got the systems, you're likely have a corporate structure, but your edge comes from adding value through refurbishments, efficient scaling, and exploiting market inefficiency. You're not buying a property, you're acquiring a project. If you don't see yourself squarely in one of these two camps, then unfortunately, I believe that Irish property likely doesn't belong in your wealth strategy anymore. So coming back to our question, is Irish property still a good investment in 2025? The honest answer is yes, but only for the right investor with the right strategy and the right expectations. The market fundamentals will support it. Remember, we have very strong demand, we have chronic undersupply, there is long-term appreciation potential, but you now face higher interest rates, lower rent growth, stricter tenant protections, higher costs, and far more compliance risk. And these factors mean one thing: the margin for error is smaller than ever before. There is no longer a day where a passive income is at play. It's an active, regulated, and sometimes thankless business. If you're not watching your numbers and reassessing your returns, you could be tying up hundreds of thousands of euro in an asset that's underperforming and you wouldn't even know it. So before you invest or hold on, ask yourself these 4 questions. Is your after-tax return competitive with pensions, ETFs, or reinvesting in your own business? 2, is your mortgage helping you, or is it draining cash flow and increasing stress? 3, are you prepared for the legal admin burden and the risk of losing control? And 4, can you hold this property for 10 plus years through the rent cycles, tenant turnover, and policy changes? Growing wealth isn't just about owning assets, it's about owning the right assets, structured in the right way inside a coordinated strategy. My job is to help clients move from a collection of random investments into an integrated, tax-efficient wealth machine. That process starts out with a simple discovery call. We'll see if there's a problem that I can assist you with. It is not a sales pitch, it's a strategic briefing. If you want to book a call, please use the link in the description below. If you found this breakdown helpful, watch my next video. Should you buy a property in your personal name or through a company? It's a crucial decision that can have a massive impact on your tax position and your long-term returns when investing in property.